So now let's see what the stock market has given in the last 24 years and what to expect in the future. In x-axis, we have the calendar year. This is the year 2000, 2001 to like this. It is up to 2023. It is there. So this number is the SIP return in that corresponding calendar year. So what is an SIP? Every month we do invest a fixed amount like 10,000. So in a year we do 12 investment, and after a year we get an average return of these 12 investments for that calendar year, and that is considered as the SIP return in that calendar year. So in the year 2000 it is -7, in 2001 it is -4. So like this, every year the SIP return is in this range, like 197. Suddenly it has given -49 also, and in 2003 it has given 97%. So this 1 year return is like, we don't know what will happen in the first year. It is like in the range of plus 97 to -49. Then in y-axis, this is the number of years a investor is staying invested in the market. Yeah, if it is 2 means an investor has entered the market in 2000 and he has stayed invested for 2 continuous years. That is, he has done 24 SIPs. If it is 3, it means he is staying invested in the market for 3 years from 2000, and he has done 36 SIP. So 4 year. It means he has done 48 SIPs. So 5 years means he is staying invested from 2000 till 2004, and he has done 60 SIPs, which means he has continuously invested, example, 10,000 for 60 continuous months. So, an investor staying invested for 5 years, what he gets, look at the return he is getting. He can get 20, 34, 42. So, if he started in 2002, he might have got 42. If he has started in 2004, he might have got only 1%. So, this is the return an investor can get in 5 years. So, if you analyze the data for 5 years, what we can see is an investor can get a return anywhere between plus 42 to plus 1% return. The data inference from this is 100% probability for capital protection. So, a investor staying invested for 5 years, we can say with 100% probability that the capital is protected. Let's see what happens in the seventh year. If an investor is staying invested for 7 years, 7 years means 84 SIPs. For 84 months, he is continuously investing. So here the range is getting now narrow. For in the first year, the range is very big, from plus 97 to -49. Then it became smaller. Then it is continuously decreasing. So in the seventh year, what you see, the maximum return has reduced to 35. The minimum is 7%. So if you are invested for 7 years, minimum 7 years, then we can tell with 100% probability that you will get a good return, a better return than fixed deposit. So let's see for 10 years. In 10 years, you see the range is it is getting very narrow, and now the range is between plus 19 to 8%. And when you see 15 years, it is getting even good. Like it is between 11 to 16%. Then if you see 20 years, it is 14 to 12%. So if you are staying invested beyond 7 years, then there is 100% probability for giving for the market to for the stock market to give a good return. Here the this return corresponds to Nifty 50. That is the top 50 companies in India. So, but what we do is we invest in the top 500 companies. We diversify and invest in top 500 companies. So, in that case, what happens is this minimum maximum values can be multiplied by a factor of 1.5 to 2 as per our allocation in market cap. For example, some investors are ready to take risk. So, what they do is they do investments in small companies, and some prefer to invest in mid companies. So it is something customization which depends on the investor preference. So what we can tell with confidence is, if you are able to invest for more than 7 years, based on historical data, I can give assurance that you will get a returns more than 12% is easily possible. And if you are staying invested for like uh, 15, 20 years, then it is easier to get like up to 18% you can get. Even if there are so many bad things happening, our returns will be good only if you invest for a long term. So what I conclude from this data is that if you are investing for less than 7 years, do not come to stock market. If you are investing for more than 7 years, then this is the best place to invest. Also, if you are investing for less than 7 years, then you need to have a more mix of gold and fixed deposit in your portfolio, and that is also possible. And it can be customized as per the customer needs. So volatility means the up and down movements. It is very big in the short term, that is 1 year. Do not come to stock market, but it is stable in the long term.